This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and we welcome you to the Rocket City Retirement Show with certified financial planner and financial advisor Cris Wallace. He's also president at WG Financial Group. And then also joining us from the firm is Graham Bauer, who is a certified financial planner, also a financial advisor at the firm. Both are here to give us some really good advice about retirement planning. That's what our show is about. Here's our phone number, 256-937-2010. Now, that's the way to reach out to Cris for a complimentary appointment. Another way you can do it, the same number, 256-937-2010. Just text. Put the word visit in there, and you can text for a complimentary discovery session. So we would love to have you take advantage of that. We give this number out all the time throughout our show. Remember, you can always check us out on Facebook, WG Financial Group 256. Cris will add anything to it throughout the week if there's any headlines you need to know regarding retirement. He will certainly update that. And then, of course, remember our motto, plan, retire, and play. And remember also, this show is available on Spotify and Apple Podcasts. Just search for the Rocket City Retirement Show. So Cris and Graham, I'm so excited to get started with you. Hello to you both.
Hello to you, Luann. How are you doing?
Great.
Hey, Luann. Good to be with you again today.
Thank you so much. Okay, after this inauguration period and Trump being in office for several weeks now, wow. It's a whirlwind. And now we're hearing all about tariffs. And you wanted to talk about that, I know, and talk about the market and what's been happening with that, Cris.
Yeah, you mentioned whirlwind, and I was thinking tornado. One of the things that I'm kind of famous for the house is really waiting until the last minute to get ready to go somewhere. So we could be going to church or wherever, and I'm going to wait till the last minute. And Jen has a nickname for that. It's called tornado time at the house.
Uh-oh.
Yeah, so I'm running through the house, putting on my clothes, putting on my belt, and running out the door, to get to church or wherever, go out to eat, whatever it is. And so it's tornado time at the house. And that's kind of how it is. How it's been in the White House a little bit. It's been tornado time. So Trump came in and signed like a record number of EOs. And then this week has been all about the tariffs. He announced that we were going to put a 25% tariff on both Mexico and China. And then a 10% tariff on a 10%, it was 25% on Canada and Mexico and a 10% on China. And, when he said that kind of spooks the market. And this is what you get with Trump, right? I mean, you get some pretty good policies, you get some growth-minded policies, but you also get some of that uncertainty, what's going on with some of his decisions. You get the volatility. I mean, he's kind of loud and bombastic in some cases. And now it's the tariffs. That's all that we hear about is the tariffs. And I just kind of want to start off by saying that, like, the T word, tariffs, it's been around for a long, long time. And the countries around the world use tariffs today. We just don't ever hear about it. I think what's kind of got everybody up in arms right now, because anything that Trump says or does, the media is going to take and run with it. So just kind of, bear that in mind. But tariffs are being used everywhere. Like, I look at, I think the Bahamas have something like a 17% tariff rate, on incoming goods. So it's being used everywhere. And it's real heavy, like in the Caribbean islands. You see big tariffs on incoming goods and whatnot. Realistically, I guess long term, and theoretically, I should say, maybe not realistically, but maybe theoretically long term, I think what tariffs are supposed to do is raise revenue for the government. All right. But it also can raise prices on incoming goods in the short run. So I think there's two main things that theoretically, again, a theory here, tariffs can create revenue for the government, which should, in theory, lower income tax, because the government would have more revenue coming in from tariffs and therefore wouldn't really need as much tax revenue from us, because we all know that the government takes revenue to be able to run. And, we could go down all these rabbit holes, and political conversations about smaller government. And I totally agree with all of that. But it takes revenue to run. And so theoretically, more tariffs should equal less income tax. I know there's been talk of really abolishing the IRS and getting rid of it totally. That ain't going to happen because, again, like I said last week or week before, I can't remember. Some of the shows tend to run together. There's not enough. We can't tariff enough to get rid of the IRS at this point. So that would be one thing. The other thing that it does, tariffs that is it should encourage manufacturers to make goods in the United States. That is, typically really what the tariffs should do. And then Trump has kind of targeted Mexico, Canada, and China. I mean, if you look at those three countries together, they make up about 40% of our imports. Those three countries are large trading partners of the U.S. here. And the U.S. in the world, if we look on the global scale, they're the largest importer of goods. And in 2022, we imported like $3.2 trillion worth of stuff. So again, the thing with Trump, I think you get is just the talking, which is, I don't know, Graham, how you feel about it, but it kind of seems like they're using the tariffs or he's using tariffs as more of a negotiating tool.
Yeah, I think that probably their greatest and best use that we've seen in geopolitics in recent memory would be in the realm of kind of using a bargaining chip, playing maybe, you could say like a big game of chicken kind of with a lot of other countries of, getting into the trade wars. Because historically, if we go back very far in U.S. history, we were primarily supported by tariffs for, a good period of our history in the 1800s or so. But also at the time, we were probably a little bit more similar to a country like, some small country in the Bahamas nowadays, like you mentioned, where our population wasn't very large. So it's hard to sustain just on income taxes. So you kind of have to have other sources of revenues. I do think that in the short term, I kind of hope that it's more of a bargaining chip for other countries to, maybe get a little, you already saw day one, they're able to get some concessions from Canada and Mexico because the tariffs started and then they're paused again. And so there's going to be more people on both borders, for the fentanyl, just policing the borders on the northern and southern side a little bit better. So I do think that that's, kind of an interesting use of it. And to be honest, I think in some ways the percentages that were used for the tariffs are maybe a bit of a hint that was the case because, it's a little weird to tariff Canada and Mexico 25% when you're tariffing China 10, considering that those are closer to allies. And, you would kind of think that it would be the opposite. Uh-huh. So I think that, that alone is probably giving a bit of a hint that maybe more of the purpose of that was to get the concessions that they wanted faster. Rather than, maybe playing a slightly longer game with China as far as those go.
Yeah, China's probably sitting over there going, man, we got a deal. We got 10%. Yeah. We got 25%. And, okay, so I'm okay with like negotiation and certain tactics and whatnot, but it impacts the markets because we saw the markets really dive off pretty hard on Monday. And then a pretty good bounce back on Tuesday. So again, with Trump, again, I like the growth-minded America First type policies. You get some of that uncertainty. You get that flipping and flopping, but you also get someone who's not afraid to stand up and be a leader and to approach other countries with really hard topics and hold other people accountable and things like that. And really, again, just kind of put America first kind of a deal. So, with that, we're talking about tariffs and taxes. And I know today we're going to get more into preserving your retirement from taxes. So, Luann, I know you've prepared some notes for us. And we can probably roll into that from there. So I don't want to keep the show too political. That's what Dale Jackson does on his channel, and he does a good job at that. So we'll kind of keep it financially related. But we've had a lot of questions about, what do we think is going to happen? And I'm like, man, I don't know, because I don't know what Trump's going to say tomorrow.
We don't know what he's going to say in the next hour,
Yeah, it could change the landscape. Yeah. So all I can say is like, put your seatbelt on, and
it's a bumpy ride.
We're at the roller coaster park. Here we go.
Yeah, exactly.
And again, we've said this before, but I think a lot of that talk, you will see affect the markets in the short term.
Mhm.
But when we're talking about, long-term retirement strategies, if there are some tariffs for a while, if there aren't tariffs, those things will affect us in the short term. But, if we're talking about a 10, 15-year period, it's not going to be something where we're telling people to, jump off, just burn the boats and, get off the ship completely or anything like that, or, going all in. So I think that you definitely got to still stick with your strategy, stick with your plan. But yeah, I've gotten definitely a lot of questions about that because it's been in the media a lot. He's obviously said a lot about it. And then, yesterday, as of the time of recording this, was kind of the big day for, I guess, about half the day.
Oh,
Yeah.
my.
And real quick, I mean, just to talk about like tariffs pre-Trump in 2021, the average tariff rate in the United States across all goods was 1.47%.
Really?
Yeah. So they've been around, they've been applied.
Low.
But well, again, when it's Trump saying something and then now it's 25%, that's quite a bit of a jump. But again, I think it's just kind of it's a tool right now. When my kids were growing up, they had their cell phones and we were like, we're going to take that cell phone.
Yep.
And they straighten up and they walk the chalk line. Right now, the tariff is Trump's cell phone. He's basically, we're going to tariff you. We need some concessions on certain things, and we need your help, right? We need the help at the border and stuff like that, both north and south. So, anyway, we can get more into the show now, so we can get off the politics of it all. But it has been a heavy topic of conversation in the past couple of weeks.
Yeah, big time. It's an exciting time. So many things are happening. Just boom, boom, boom. That you don't know which way to look. So, all right, but let's get into this. We're going to talk today about preserving your retirement from taxes. I think, people tend to think, oh, healthcare is going to be so expensive in retirement. But you say, Chris and Graham, that taxes are really something we have to pay attention to.
Well, we do. I think if you look at taxes in general, Luann, I think taxes will be, for some people, maybe the largest expense in retirement. And I don't think most people realize that. I think a lot of people think about inflation because we've just come off of that. And Graham, you've studied this kind of stuff, but recency bias. So inflation is very top of mind for people. Taxes is always top of mind, but I think some people there's going to be taxes involved. So people just are like, okay, I don't really understand it. I don't know how I can save on taxes. So I'm just going to deal with it. But silently throughout your retirement, you're going to pay hundreds of thousands of dollars in a lot of cases in taxes, depending on the size of your nest egg and the type of income that you have coming in. So to me, it's often overlooked, but it's our firm when we're sitting in a meeting, Graham, and I know when you lead some of these meetings and you're doing some of our service meetings here, the first thing we kind of sniff out is, okay, you're doing this. How does it impact taxes? Everything is like, okay, how do we point it back to taxes? And how do we say, okay, there's a little bit more efficient way to do that? Yeah.
And even when someone is writing into us right off the bat, I would say, we kind of see when, someone writes in and they want to come down and sit down with us. A lot of times they'll put, a couple notes about why they're writing in and maybe a little information about themselves. Not that they're required to do that, but some people just like to say, a reason why they're reaching out. And I would say the biggest reason that people put down is needing help reducing taxes or needing help understanding taxes. And it's easy to see why, because it's a very complicated topic. I think there are some things that are still very complicated, like, how to allocate a portfolio and Social Security. There is a lot of complicated nuances there. But I do think taxes kind of gets into a whole other animal of people not wanting to also get in trouble with the IRS. So there's a lot of things there to consider. But I think, tax, I guess it would be called tax avoidance, not tax evasion. Tax avoidance is what, most people are looking for.
Keep us safe, Graham. Keep us safe.
So really quick on that, because I saw this the other day. I was on LinkedIn. I don't use LinkedIn a lot. I have an account because it feels like just if you're an adult and work, you have to have one. I don't know. It's like some law that was passed probably that I didn't see. But I was on there and I saw an advisor who I don't know personally, just someone who I guess requested to connect with me, post something about how he was advising someone to take their compensation from work. And the replies were just flooded with enrolled agents and CPAs saying, this is tax evasion. This is tax evasion. They're going to get in serious trouble with that. So at the same time, you want to make sure who you're working with understands what they're doing. And if anyone is telling you, hey, I can, save you today an insane amount of taxes, you might just want to double check it because, there is tax avoidance and tax evasion. And, you want to make sure you're on the right side of that equation.
Yes. And as we get into some tax talk today, we're not CPAs, we're not enrolled agents. We always tell everybody we work with, hey, this is the layout of what I think we ought to do. You need to go have this blessed by your CPA or tax accountant that you're working with. So just want to throw that out there kind of as a reminder as we start to talk through some of this. But I always go back to saying this. Graham and I both have been through the CFP curriculum, and there's a big, huge book on taxes. It's actually the most difficult course in the CFP curriculum. So as an advisor, I do think that you need to have knowledge on how the tax code works, how money is taxed, how certain withdrawals impact certain things. So we use the analogy of the Rubik's Cube quite a bit. Just understanding when you're twisted on that Rubik's Cube, you may be impacting an area that you're not aware that you're impacting. Yeah. So, with that, we kind of lay out a plan, but we always tell people that we work with to go get it blessed by their tax person.
Yeah, I think that's so important. So, the IRS tax code is full of, oh my gosh, so many sections, and it's got all these different rules. And then if you break the rules, man, you're going to be paying some fees and things like that. And the thing is, we're all supposed to follow these rules and we don't quite understand them all. And that's why thankfully we have someone like you guys to turn to. Now, we know to file our taxes every year, okay? But you guys say there's actually a more proactive approach that pre-retirees need to take. So there is a difference between getting our taxes prepared and then tax planning, which is part of your retirement plan, the Rite Retirement process, Cris.
Yeah, correct. I mean, obviously, when you do your taxes, you're going somewhere, more than likely you're sitting down with someone or you're dropping off your documents or whatever, and they're preparing the taxes. And at that point, there's not a lot you can do. I mean, you can make some Roth IRA contributions up until the filing, traditional IRA, but by and large, it's all historical at that point. The whole conversation is basically historical. There's nothing you can do to change it. Like, we can't change what happened 100 years ago in history. In a lot of cases, what's already taken place by the end of the calendar year, you can't do a lot to change that. So there is an element of what we do that is more like investment tax planning, offering some different types of tax strategies. And if you're listening to the show and you're new to the show, it is not put all your money in a whole life policy and take tax-free loans against it. That is not at all what we're talking about. We're talking about being strategic in the accounts that you're saving in, being strategic in the accounts that you're pulling from, and really using what I like to call some tax stacking type strategies with some charitable things, charitable giving, the way that you're pulling money out, tax loss harvesting, et cetera. There's lots of different things you can do there. So it's about being more strategic in the planning side so that when you get to doing your return, you can kind of know what to expect. I'll give you an example of something I've seen before. So I've had a widowed female come into my office before, and they're working, and they're drawing income, and they're also drawing the widow's pension of Social Security. Mm-hmm. Well, they did not think about the tax implications of doing that. So they're working, and they're also pulling their Social Security, and now all of a sudden, and they're over full retirement age at this point. So there is no penalty, right? Good, so now you have now you have the full wage, and now you have the full retirement Social Security coming in. So they're pulling that, and I'm like, well, it's really going to impact your taxes quite a bit, like significantly. Oh, it'll probably just be a little bit. I'm not. Let me kind of run some numbers here. The bottom line is there would have been an impact of taxes about $6,500 federally that would have been owed, and that's what I call a surprise. Mm-hmm. And so I think that's where planning comes into play, where if you know about it ahead of time, it's like, what can we do to correct it in January, not in December, or looking at it in April when it's already on paper in black and white, and you're going, wow, I wish I'd have known. So in a particular case like this, you might consider putting a little bit more into your 401k, since you're still working, to offset some of that income tax. You might want to increase withholdings a little bit to offset some of that tax. Now, that you're not really going to offset the tax in that case, you're just going to withhold it so you don't have to pay it at the end. So there's a couple different strategies here. So that's why it's important, I think, as you're in your pre-retirement years and you're leading up to retirement, that you're working with somebody that is looking out for other things than just your investments. I mean, there's plenty of brokerage firms around the area where you can go and somebody's going to take a look at your investments. There's very few shops that do what we call kind of more holistic financial planning, where in our case, being CFPs, looking at the more holistic side of financial planning in general, where we're hitting on all of the elements of financial planning, not just the investments.
So, all right, obviously we need to start thinking about taxes as we head into retirement. About when should we start thinking about it, Graham?
I think the best time to start thinking about taxes would have probably been 20 years ago for a lot of people.
Yesterday.
Hey, I wasn't even thinking about retiring 20 years ago.
Exactly. The decisions you make and how you save early on obviously affects you in the future, but it's usually never too late to get more tax efficient. So there's different phases in your financial life, and they really do coincide pretty well with the stages of tax planning. Because early in your life, you're in that accumulation phase. So typically the tax planning that you need to understand is more how to accumulate in the most tax efficient way. So, that depends at the time on the income you make from work, the type of compensation you receive. If you're, an independent contractor, or if you're W-2, or if you get stock options, all those different things. And then as you get closer to retirement and into retirement, now we're in, the distribution phase of life. And that's also going to coincide with how do we get income and take this money out in the most tax efficient way. So, ideally you would have done the most tax efficient thing on both sides of that coin. But I would say typically that's not the case. However, there's still things you can do early in retirement. And I think if you're still working in a couple of years from retirement, that's a great time to start evaluating what your tax strategy is going to look like, because even your retirement date could definitely, maybe be affected or changed or influenced by some tax strategy you have. Maybe you want a little bit more time before required minimums or Social Security to do certain tax strategies. So there's definitely, an ideal time to start thinking about it, but it's never too late.
Yeah, Luann, when you asked that question, you didn't really pitch it to either me or Graham. I just pointed to Graham. I was like, you're up. he took it and ran with it. So, no, he's exactly right. One of the things I just want to touch on something he mentioned there is your retirement time may impact the strategy. So there's lots of different times you can retire, and it may have some different impacts. And just to throw out a couple, the rule of 55. So if you're working for a company, got a 401k, separate from service in the year that you turn 55, you can take out of that 401k without the 10% additional penalty, but you're still going to pay taxes on it. The other date would be like 59 and a half, retiring. You have IRAs. You can't really take from the IRA without penalty until after 59 and a half. And then in between, like really any time below 65, then if you don't have health insurance and you're going through the exchange and you're trying to keep your income lower, keep your modified adjusted gross income lower to kind of pick up subsidies. So there's all types of tax strategies. And sometimes, again, excellent point that he made there was basically your retirement time may dictate some of that tax strategy. So I went back to school late in life and graduated with my degree in my latter 40s. I think I was 49 at the time I graduated. Just like going back to school, it's never too late. It's also never too late to start the tax planning.
So, okay, here's something that we have talked about a lot here in the past couple of years is the tax code. Okay, it's set to expire. The 2017 Tax Code and Jobs Act is Tax Cuts and Jobs Act is set to expire.
There we go.
Thank you. And anyway, we, within this administration, we kind of don't know what's going to happen, but it's set to expire in 2026. So I want to hear, what you have to think about that, Chris and Graham. And, obviously it's important to take advantage of current tax planning opportunities before any changes happen. We don't really know if they're going to change though,
Well, Trump's getting rid of the tax code, I thought, is what he said, right? Going to get rid of the IRS. And so, no, here's kind of the thing. It takes Congress to approve all of that. So there's a lot that goes into changing the tax code. What I think we're likely to see now that he's in office, and obviously the Republicans control both sides of the House or both sides of Congress at this point. I definitely think that we're likely to see some changes to the current policy. I don't know that we're going to see taxes get a whole lot lower. I think what we're likely to see is just some modifications and then probably some extension. But here's the deal. Like we talked at the beginning of the show about Trump coming in kind of like a tornado. We know at the tail end of, his 4 years, there's going to be a new president. So, how long, if he makes some changes, how long does that really stay in play before somebody comes in and starts ripping up everything that was done previously? Because, Republicans do it too. They come in behind a Democrat and they're like, oh, this is terrible and whatever. Changes this, changes that. I mean, it's going to happen again. So the thing that I think we want to do, I think, as people, as we're out there investing, this is myself included, Graham, as well, is we want to be aware of what the tax code is today, and we want to make sure that we're efficiently taking advantage of the things that are available legally within the tax code today, because we don't know what it's going to be tomorrow. Right. And wherever possible, we want to try to disinherit the IRS to some degree. In other words, we want to have more control over what we're going to have to pay in the future versus what they say we're going to pay, because they can always come in and change code, and then we're subject to do whatever the code says on the tax form. But if we are, converting traditional money to Roth, or we're contributing to Roth accounts, then we are essentially putting ourselves in a place or in a position that down the road, we don't have that IRS as a partner at that point. It is all our money, and we don't have to share any of that. That's kind of my thoughts on that.
Okay, very good. Now, I want to get to the RMDs. Okay. Right now, where they are, the required minimum distributions, when someone has to start taking them, is 73 years old. So, Graham, tell us the impact that RMDs have on our taxes, please.
RMDs, they can have a big impact on some people's taxes. I wouldn't say that they're always quite the boogeyman that some people make them out to be. They start out fairly low and they scale up over time. But one thing I like to look at when we're talking about required minimum distributions with clients is one, how much are you already taking out of your IRAs every year? So if there's someone with a lot of IRA money, and let's just say that they're 2 years away from required minimums and they're withdrawing $30,000 a year to live on, and year one, their required minimum's only going to be $20,000 a year, then for a good while of time, there's a pretty good chance you're going to be able to cover your required minimum with just your reoccurring withdrawals that you're taking on a monthly basis. And then another thing to think about is, what are you doing for your charitable giving? So if you're doing some qualified charitable distributions as well, that's another way to really lower those. So there are some people, I have a few clients starting required minimums this year for the first time. And for a couple of them, they are in a situation where it's like, oh, we hit RMD age, but we've kind of been taken RMDs in a sense already because we've been taking income every year. Mm-hmm. So I do think that's something to look at. And further, you are out from RMD. So if you're like 62, it's pretty hard to project, what your RMD is going to be 13 years from now with account growth and, if the rules change at all and how they calculate it, there's all those things. So I think that it gets a little harder to project when you get further out. But for a lot of people, they might not be so bad for that group of people. For a flip side group of people, the person that has a lot of income, maybe you're a federal employee or military or something, and you have a pension and you have Social Security, and then you have a lot of IRA money somewhere else. Now we're talking about required minimums really starting to sting when you get there, because as they scale up over time, you might not really need the IRA money, but it's going to get force fed onto your tax return every year unless you're giving away, a ton of money. So I think for different people, it warrants different amounts of consideration and has a different effect on your taxes overall. I mean, I've seen situations where people are taking required minimums and they're in a 0% federal and state bracket. So, there are some scenarios where, it's not hurting you at all, but that's why it's really important to plan ahead for that, kind of try to project as much as you can and, see how it's likely to affect you and what you can do about that.
Yeah. And Luann, I know we're just really at the tail end of the first half of the show. So if you're listening and you're catching the first half, maybe on the way to church, you can hop out to Spotify, Apple Podcasts, pick up the whole show there. So just want to thank everybody for listening. So, Lou Ann, when we come back from the break, I actually want to talk a little bit more about what Graham said, especially with RMDs and charitable giving and things like that.
If you're pondering the longevity of your retirement savings with questions like, is my nest egg sufficient? Or how long will my retirement funds last? Consider scheduling a session with Cris Wallace. Text VISIT to 256-937-2010. Again, text VISIT to 256-937-2010 now to set up your appointment.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
With so many worries in life, market volatility shouldn't be on your list. Help ensure your retirement plan is stable and independent of market swings. Just get in touch with Cris Wallace at 256-937-2010. That's 256-937-2010 to start planning.
All right. Thank you so much for joining us. You're listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer with Cris Wallace and Graham Bauer. All right. So we've been talking about just, what we can do to preserve our retirement from taxes. And one key thing we were just talking about were the required minimum distributions. Now, right now, you have to start taking them at 73. We know that's going to be changing here, with legislation in a couple of years. But what else did you want to say about that and the impact that RMDs have on our taxes, Cris?
Yeah, so they actually already are changed. So 73 is kind of the age right now. But if you were born in 1960 or later, then your RMD age is 75. So I don't anticipate any further changes on that for quite some time.
Okay.
Just so it's kind of already in law with the Secure Act 2.0. What I want to talk about is just kind of piggyback on Graham's comment about charitable contributions, especially when you start taking RMDs. The first rule of thumb here, and again, we like to teach when we're on radio here. So I've had plenty of people come to the office and say, wow, you'll talk about some really good stuff and you give away a lot of good information. And I say, well, yeah, that's why we see a lot of people from radio. And that's why we have a massive client base from just radio alone. The rule of thumb here is you always want to give your least efficient taxable money to charity. So we always want to, if at all possible, when we're able to, we want to give IRA money to charity. So one way to do that is, as Graham noted earlier, with QCDs, qualified charitable distributions, for your RMDs, that's essentially giving that IRA money directly from your IRA to a charity, a 501c3, and you don't have to pay taxes on it. Well, guess what? Neither does the charity. So you've basically satisfied your giving. You did what God's called you to do, and you're giving, and no taxes are due there. You can start that at 70 and a half. So that's the way that we always want people to do it that are charitably inclined, is to be utilizing that QCD provision. But there's also other ways to give below 70 and a half. So if you have a non-qualified account with non-qualified assets in it, say appreciated stock, you can also start gifting in-kind shares to the charity of your choice, depending on if they have a brokerage relationship. A lot of large charities do. But that's another excellent way to kind of efficiently give. If you have a highly appreciated asset, something that's, maybe you bought for $100,000 and now it's worth like $1 million, then you could use what's called a charitable remainder trust, and you could donate it to a charitable remainder trust. There's some deductibility there. There's also requirements. So minimum of 10% has to go to charity. But that's another strategy. You can also use a CRT post-death as well for big IRA money, because there's some tax advantages for your beneficiary. So I'll give you an example of just, we've seen situations like this before because I have to stay compliant with my languaging. So maybe I've got a widowed female comes into the office, sits down with me, and she's got a non-IRA account. So we call that non-qualified. So she's got a non-qualified account, and she's got an IRA, and she's also got a Roth. Okay. Largest assets would be in this non-qualified account. Okay. So we have a nice little chunk in the non-qualified account. What I may or may not have seen is that the beneficiary of that, or one of the beneficiaries of that non-qualified account was a charity. So knowing that this individual has an IRA, I know right off the bat that that's my most least efficient tax money, right? So, and I can know this person's charitable because maybe they've told me they're charitable, and also I can see that one of their beneficiaries is 15% to a charity. So the recommendation that I might make in a situation like this is let's remove the 15% beneficiary on the non-qualified account that's going to your kids, because we know that beneficiaries of non-qualified stock receive a step up in basis. So if mom and dad paid $100 for the share of stock and they die and it's worth $500, when it's inherited by the kids, it's inherited at $500. It's called a step up in basis. So we take the charity off of that non-qualified account because we really want the charity to have money because we're charitable. And so what we're going to do is we're going to put the beneficiary of the IRA as the charity. That way, the kids can keep all of the non-qualified money at a stepped up basis. So essentially when they receive all of that, they can essentially sell it with no gains or no taxes whatsoever. And then we let the IRA money go to the charitable company or charitable institution. So that's when we're sitting down with somebody, that's the type of stuff we're looking at. And that right there, to us, simple. Like we see that like right off the bat, snap our fingers, boom, seen it. I've seen situations where these individuals are with other firms and it's right there in front of their face and they just never saw it. So they come into us and do a couple of meetings and we're like, okay, we just need to really just change the flow of things and it'll be so much more efficient for you. But that's kind of how we work with families. So that's just a good example of a situation that, I've kind of seen similar to that before, just to try to help the listener out. And again, I know to people listening to the show, Graham, and you know this, is when you first started the CFP curriculum, you started it's kind of hard to grasp all of these concepts. But once you see them day in and day out, there's pattern recognition that I think we're able to see. To try to teach this over the airways, it's kind of difficult. But hopefully you're picking up little nuggets along the way that'll just kind of help your family as you're listening to the show. Yeah,
it's always going to be one of those things that becomes just second nature, simple to us to see, but to the average person, there's between the different rules on accounts and the taxes and beneficiaries, there's so much to know that it just becomes hard for the average person to keep up. And I'll give one more example of just a beneficiary. I wouldn't even say mistake, but maybe opportunity that some people might have in a similar vein. I've seen situations where, someone might be unmarried, doesn't have any kids. And so their beneficiaries are kind of spread maybe between some nieces and nephews, siblings, things like that. Again, that's another scenario where it might be a good thing to say, hey, well, if you have a sibling within 10 years of your age, they can actually stretch your inherited IRA over the course of their lifetime rather than maybe giving it to a niece or a nephew in their 30s or 40s who are closer to peak earning years and are going to have to pay it over a 10-year period. So, I mean, there are just things like that where even on the beneficiary side of things, there's maybe some potential for just some more efficiencies there over time.
For sure.
Okay. So, guys, talk about the different types of financial professionals and the benefits of working with a retirement planner.
Well, obviously, Graham and I are certified financial planners. So actually, I think we're probably the only two certified financial planners on air, maybe, here in Huntsville. And I don't know if we look down into Birmingham, if we're the only radio show with two on air. I'm not sure because I don't know that market as well. So one of the reasons that we chose to go that route is just due to the broad exposure from an education standpoint. So for a lot of designations, you go and you maybe take one test over a certain area of finance, whatever that is, and they issue the designation. Well, the Certified Financial Planner curriculum touches on many different areas of financial planning. So as Graham and I kind of sit here today, we have a broad knowledge of all areas of financial planning, which includes retirement. So I don't care if you carry a retirement planning designation, the CFP encompasses all of that and more. And there's a reason why there's less than 800 in the state of Alabama who are CFPs. Now there's hundreds and maybe even thousands of actual financial advisors, and I'm using my quotations here. And then there's thousands of insurance agents, but there's less than 800 CFPs. And the reason for that is, in my personal opinion, having gone through it, and Graham can attest to it, it's not like a super easy road. I mean, it's difficult study. It takes a lot of time and invested in that. And then you're tested on that over, I think it's an 8-hour or so, or close to 8-hour test in 2 different halves. And it's very comprehensive. So we feel, and obviously we have a bias towards that because we are that. But once I went through the curriculum, and I actually passed the test back in 2016, as I was going through that curriculum, I was like, wow, I didn't know this. I didn't know that. So there's some learning that you do when you go through the course. And I think that's what makes us a little bit different than, I would say, a lot of the local advisors here. And I'm not bad-mouthing anybody. I'm just saying, hey, this is what we chose to do. This is the route we chose to go. But our area, even though we're CFPs, we're still core focused on retirement. So looking at taxation, income planning, even legacy, tax efficient strategies, IRMA issues with Medicare, Social Security. A lot of advisors don't understand Social Security. A lot of advisors don't understand Medicare. I've been licensed since 2009 with a health insurance license. So nearly as long as my daughter's been alive, I've been health insurance licensed. So there's a lot of history there with me personally. And Graham's been a team member of mine for quite a while now. And, he kind of came up under my wing, and then he's kind of sprouted and really, really grown himself. And now I'm able to trust him with a lot just because he's able to regurgitate back to me. Something must have fallen in the other office over there. He's able to regurgitate back to me stuff that, that is high level stuff. And that's given me a lot of, trust in him. So, it's just a little bit about who we are and really what we lean towards in terms of the difference between, say, us and just the random broker person, I guess.
Yeah, and of course we are a little biased on the certification, but at the same time,
a lot probably.
if you Google articles about what's the best financial planning designation to have, you'd be hard pressed to find one that doesn't have CFP listed at the top. Sure. There's tests that maybe you could argue are a little harder, like the CFA and CPA, but they're not focused just on financial planning holistically. They're very focused on one area, like investments or taxes. And just to put it in the perspective, I was curious to just see, there's almost 700,000 CPAs in the United States, and there's a little under 100,000 CFPs. So there's, in the whole US, there's not a ton. And I don't think that's because, I'm not going to say that the CFP is hard or anything, but
by no means,
I'm not making that comment, but I'm just saying that of all the advisors in the United States, it is, looks like it's around 1 in 4, 1 in 5 that has it. So it's
interesting.
Not quite as common as you might think.
Yeah.
Yeah. And when we talk about 700,000 CPAs, there's just a lot of people that really like to do taxes, I guess.
Yeah.
Because the CPA exam is no joke. Yeah. And also the CFA actually arguably is probably the hardest exam out there to take, but it's more investment focused on if you're a portfolio manager and not necessarily a planner. So again, that's just kind of who we are and why we lean towards and gravitate towards that designation, Luann. And that's probably the difference when you're asking about the difference in retirement planning and whatnot. I mean, I've reviewed portfolios from people that supposedly work with retirement planning, and there's just opportunity, right? I mean, it's just, again, not pitching rocks. It is what it is.
Right. So I love it. You guys have the education, you have the license behind you. And so definitely.
And the gray hair. Don't forget the gray hair.
And the gray hair.
me, that is.
Not Graham, but you. Yeah. As you're helping retirees head into, that wonderful time of life, and you want to make sure that they're headed in the right track. And so that's where I want to go next. What should be some things people should start considering if they are thinking, oh, I'm going to retire, next 5 years or something like that?
Yeah, well, I think one of the first things that I think somebody can do is really start to focus on, when do I want to retire? what am I spending today? How much debt do I have? And just because you have a house payment doesn't mean your retirement's going to fall apart. I think everybody has this psychological mentality of, I want to make sure that when I get to retirement, my house is paid off. I actually think that you have to be careful with that, because I think you can make too much of an extra mortgage payment, if you will, towards principal, like a lot of people do. Like, say my house payment is $1,200 and I'm paying $2,000 or whatever. So I'm putting an extra $800 towards principal. That's great, but maybe my mortgage rate is 3%. And so now I'm piling all this money towards extra principal because psychologically I want to go into retirement and I have a house payment. Meanwhile, you're missing the opportunity to put into your 401k and potentially pick up a higher growth rate on your assets, your liquid assets that you're actually going to use to go traveling and buy groceries and cars and things like that. The last time I checked, when I went on vacation, I was checking into the hotel. They did not take my house value as a means of payment.
Yeah, right.
So I could say, hey, listen, I've got $400,000 of equity in my house. Can I check into the hotel? No, you need assets, liquid assets, cash to be able to do that. So there is a balance there. And so I think if you're about 5 to 7 years out, it's okay, maybe I should check with someone, because I heard from another radio person or maybe a TV person or whatever, they said I should do this. Maybe that's not the best way. Maybe that's the best way when you're 20, but maybe when you're 55, maybe that's not the best way. So it's worth starting to put together the basics of a plan and starting to understand, this is how I am today. Where do I need to get to? And what does, that goal line look like for retirement? What do I need to have in place to make it work?
Excellent. Okay. Very, very good. So, just real quick, everybody, you are listening to the Rocket City Retirement Show. So happy to have you along. I'm Luann Fulmer here with Cris Wallace, Graham Bauer, both certified financial planners, financial advisors at WG Financial Group. If there's anything you're hearing on this show, or if you're like, hey, I need to ask them a question about something, you may go see them complimentary. Call or text the word visit 256-937-2010. 256-937-2010. Call or text the word visit. And remember, you can find us online anytime at wgfinancialgroup.com. So we're talking about, preserving our retirement from taxes. I guess now, why don't you guys walk us through what goes into when you create a tax efficient strategy for a client that you are working with? So I don't know who to direct that to, Chris or Graham, either one of you or both.
Yeah, I'll kind of lead it off here. So again, when someone comes into the office, our staff is we're kind of trained to look first at tax efficiency. Now, you got to be careful in that, and when we talk about taxes and being efficient and all that, you don't want to let that be the complete enemy, because there is value in doing things a little bit differently that may not quite be as tax efficient, but it's better for that specific situation. So there is an element of what I call real world. A lot of listeners know I spent nearly 20 years in manufacturing. We had a blueprint. This is exactly how it's supposed to work. And then when you get the thing in the injection molding press, the tool doesn't quite spit out the plastic parts exactly like you wanted it to. So we have to do some modifications. We have to do engineering changes to make those parts better and functional in the field. The same thing can be said for your financial plan. But what I will say is, if you're looking to create a tax efficient strategy, number one, first and foremost, we talked about it earlier. If you're charitable, make sure that you are giving to charity in the most efficient way possible. If you're saving for retirement, then I think it starts to come down to where, let's first start with like income. Okay, if I'm in a low income bracket right now, or a low tax bracket because my income's kind of low, I'm not in my peak earning years, as we like to call it, then I think you got to lean more Roth and probably some brokerage account savings at that point. So some after-tax savings. But the higher you go in income and you get towards that, that peak earning year, say you're in your middle 50s, and this is the point where you're getting ready to retire and you're like, man, I'm making the most money I've ever made in my life. And this is scary to walk away from a 6-figure salary, to have nothing but Social Security, maybe a smaller pension or no pension. But when you start to get to those peak earning years, then I think you have to start looking at the advantages of some pre-tax money. And I think it's the easy route for somebody to say, you should put it all in Roth because you just don't know what taxes are going to be in the future. Well, yeah, that's super easy to say that. But the majority of people that we work with are not in the same marginal rate in retirement as they are when they're working. And for sure, the average tax rate is lower because we know once you start Social Security, it's taxed a little bit differently. And essentially, it kind of helps lower your effective rate there. So, I think as you make a little bit more money, you have to start thinking, okay, should I do more pre-tax? How much should I do Roth? Should I be putting some in a capital gains account? So there's a lot of those types of things that go into a tax efficient strategy. And then when you get into retirement, now you're starting to pull out of the accounts and you have to start worrying about IRMA limits. And I've had a lot of people come through the office in the past 6 months talking about, they busted through the first 1 or 2 IRMA brackets and now their Medicare premiums are increased. So, but that's kind of the basics of it, what goes into it. That's just kind of some of it, Luann. We could probably talk for a full hour on every little thing, but those are some of the basics. When we talk about big savings, buckets, where to put your money.
Yeah, and when someone's in retirement, like you mentioned, from an income perspective, I do think that when you're talking about a tax efficient strategy in retirement, income is kind of at the forefront of that in a lot of ways. Of how are we going to get income? How are we going to withhold taxes for that? But then also, I mean, one of the bigger things I think that a lot of people, when I'm getting a call from someone, there's a good chance it has something to do with them calling saying, "Hey, Graham, we're buying a camper. How should we get the money for that camper? How should we pay for it?" And I think that's one of the big advantages of working with someone is in a way you kind of have us, on retainer a little bit, someone who kind of understands your tax situation and understands your financial situation and, where your accounts are at, what you have spent so far this year, where you've been, pulling so far. And so that becomes a big topic of conversation, especially if someone's got multiple different accounts. If they got Roth accounts, IRA accounts, non-qualified accounts, it can be a little overwhelming, even if okay, well, I'm taking my income from my IRA at this point to say, okay, well, maybe we're buying a new car. Where should I take that money from? Should I take it from the same place? How is that going to impact my taxes this year? Because, like you mentioned a minute ago, obviously we make an initial plan, but goals change, lifestyles change, and a lot of things can change over the course of a retirement plan. So we have to be flexible to that. And those conversations, I think, are definitely a way that, we help add value and also just help people feel comfortable to go out and fund those bigger goals because they know that it's kind of been, I guess, somewhat signed off on and saying, hey, that's great that you're doing that. Here's the most tax efficient way we can help you do that.
Yeah, I'll kind of piggyback on what we're talking about here. But in 2025, a married couple can withdraw roughly $126,000 from a brokerage account, so like from a capital gains account, and not pay anything in federal taxes. So this is part of that tax code efficiency because we know that capital gains is taxed at 0, 15, and 20. Most people really don't get to the 20. Most of it's 0 and 15. So really understanding the types of ways that you're saving, the types of money that you have, and then once you get to retirement, how to pull that out in some of the most tax efficient ways possible. And sometimes you can, sell non-qualified stock and pay for different things. You can help fund a Roth conversion, by selling, non-qualified stock that's kind of appreciated, but because you're in such a low bracket, you're able to do that at a very low rate. So lots of different things goes into that tax efficient strategy, Luann.
Right. Okay. So now kind of walk us through specifically strategies that would help us keep more money in our own pockets in retirement.
Yeah. So again, we're not big fans of life insurance. So there are a lot of agents out there. This kind of goes back to what we talked about earlier about being certified financial planners, is that, we're looking at your retirement plan holistically, but one of our, call it tactics or strategies, is not to have you put money into a whole life policy, tell you that you can take tax-free withdrawals so we can make a commission. That's just not what we do. All right. So one of the big strategies, I think, right off the bat, if you're going into retirement, one of the big things I think you can do, and Graham, feel free to disagree with me. You're fresh out the books, and if I'm got a few years on you, so you got that young brain. But one of the biggest things I think you can do is look at your Social Security claiming strategy. So we can clearly demonstrate when we look at claiming Social Security early, it does several things. It lowers, obviously, the amount you're going to take. So if your FRA, your full retirement age is 67, you take a 62, we know it's a 30% reduction. So right off the bat, we know that's lower. So that's less income coming in from Social Security. which likely means that we have to pull more from other sources that are taxable. And so what that does is that creates taxation on Social Security faster than if you had a larger amount. So that is one of the big things, the big strategies we think individuals and families can do is look at their Social Security claiming strategies. Now, every family is a little bit different because maybe you have age differentials between the husband and wife, and then you have to look at some different strategies there. But that would be, I would say, kind of number one is one way that I would look at it. Graham, I'll kind of toss it to you and see if you can throw another one out there, but that would be kind of the foundational one for me.
Yeah, I mean, I think this one is probably the main one, and it kind of coincides with it. But I do think Roth conversions too are, going to be something that you just got to think about. And in some ways, it feels like the obligatory answer. But I think that it is the obligatory answer because of, especially for people with, really big IRA accounts, potentially could bring on, a lot of long-term tax savings. So, we'll look at it, I would say, for almost every person that comes in, unless they just, have all Roth money or something like that. And for some people, it doesn't make sense, or maybe it doesn't make enough sense from a mathematical standpoint, and you're really just kind of would be hedging against future unknowns. But then, if you're sitting out there and you got a couple $1 million sitting in an IRA, over the course of your lifetime and, an inheritance likely for your kids. I know people say, oh, we're going to spend all our money in our lifetime. You're probably not. And I wish more people would, but you're just probably not. There's very few people that do that. So you got to think about, the inheritance as well. So over the course of a couple lifetimes there, I mean, there's opportunity for some substantial tax savings. So, in some ways it's kind of a buzzword that gets thrown around, but it's not one of those things like maybe some life insurance and whole life and IUL that we might think is a little gimmicky. It gets talked about because in a lot of situations, it does really work over the long term.
Yeah. And I think when we talk about Roth conversions, I think there's a portion of the listener base right now that can do what we would call free Roth conversions, because we know if, we talked about this a lot on the show, maybe not here recently, but if you only have Social Security income, you're in a zero tax bracket, both federal and state of Alabama. So in a case like that, there's a window of money that you can pull out of an IRA without any taxes on it, federal or state, especially if you're age 65. So that would be what we would call a free Roth conversion. But there are people out there today that they don't know that they can do that, because we've done that internally for some of our clients where they have that leeway and they're basically on Social Security. The other thing I would mention on Roth conversions is, man, if you're like in the 12% bracket, you got to think about it. That's converting money at a pretty low rate. And I just think that makes sense to go ahead and, at that point, you've kind of made a decision. I'm going to disinherit the IRS with part of this money by converting, say, at a 12% bracket rate. And I think it just takes looking at that and working with somebody. And there are people right now listening to the show, Lou Ann, they've listened to the show for a while and they're like, you know what, I'm just doing all this myself. I'm doing everything Chris is saying. But I'm telling you, man, when people come in the office, like, they're not doing everything we're saying. Mm-hmm. And people that have been listening, we've been on the air now for 8 years.
Yeah.
8 years. Longest running independent show in Huntsville. Super proud of that. And we have a good following. We have a good listener base. And I've had people come in 6, 7, 8 years listening. And they're like, yeah, I've been listening to you for a long time. And they're still missing the mark on some things because this is not what they do every day. They're building rockets and defense parts and things like that. Yeah. This is what we're doing. We're sitting behind computers, looking at plans, looking at the tax code, keeping up with Secure Act, saying, hey, did you know you could do this and make it a little bit more efficiently? One of the giving strategies that we talk about at the office, I don't have time to get into it right now on the air because we're right here at the tail end of the show. But when I start explaining that, the eyes glass over. And I'm not talking about QCD. I'm talking about another giving strategy that we'll utilize. And the eyes just glass over because it's just a lot. It's backwards from the way that you would normally think you should give. And so we say, hey, this is actually more efficient to do this. And they're just like, can you explain that again? Can you go over that again? And again, it's not because they're not intelligent enough. They're, by far and away intelligent. It's just that we do it every day. So, Luann, good show on taxes. Taxes and tariffs, actually. Yes. We talked a little bit about tariffs in the beginning. So, hope everybody has a great week. If you want to set up a discovery session with us, all you have to do is give us a call, 256-937-2010. Again, the number's 256-937-2010. I hope everybody has an awesome and blessed week, and remember to serve every person in every situation with a servant heart.
AEWM provides services without regard to political affiliation, and the views of individual advisors are not necessarily the views of AEWM.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.